Good afternoon, ladies and gentlemen. Welcome to the SERINUS Energy PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Jeffrey Auld, CEO, Andrew Fairclough, CFO, and Calvin Brackman, VP of External Relations and Strategy. Good afternoon.
Good afternoon, thanks. Well, welcome everyone. My name is Jeffrey Auld, I'm the CEO of SERINUS Energy. As Mark said, we have Calvin Brackman with us, who's our Vice President of External Relations and Strategy. And you'll be hearing from Andrew Fairclough, who is our CFO. He'll run through the bulk of this presentation. Of course, this presentation is to focus on our full year 2020 results, which we announced on Friday the 26th. I'll run through a couple of quick slides and then I'll hand over to Andrew and we'd be happy to take questions at the end. Very roughly, I will run over a review of 2020. Now, I think for everyone, 2020 was an interesting year. We entered the year with about just under 2,500 barrels a day of production, which we'd managed to increase quite significantly towards the tail end of 2019. And at the commodity prices that we entered the year, we were looking at a very positive year where we could take that cash flow, pay down some of our debt, and work through the operating plans that we had at the start of the year. Of course, about this time last year, all of that changed. I remember talking to Andrew at the end of February when we were talking about the treasury function that we were going to use to accrue our cash flow to make a debt payment that was required at the end of June. 2 weeks later, commodity prices had collapsed. We were talking about major economies locking down for a pandemic, and we found ourselves on the phone with our bank talking about the fact that it did not look like we were going to be able to make a debt payment. In that quarter, our revenue fell by 68%. So a very, very dramatic change, like everyone in the world. But 2020 ended up to be a challenging year for us, but a year that we managed to get through and really positively change the business. And fundamental to that was that crystallizing event, that catalyst of commodity prices falling, demand falling for commodities because of the pandemic, that forced us and our bank to come together and to negotiate a way out of the debt situation that we found ourselves in. And what that entailed was pretty much a 50% off sale. So we raised capital. We paid $16.5 million to the EBRD, our bank, and in exchange, we retired $33 million of debt. And so that meant we exited 2020 as a debt-free company. And as at the 31st of December, we had $6 million of cash in the bank. Production for the year averaged 2,340 barrels. That was down a little bit in December, simply because really the first operational effects of the pandemic hit us. And what happened was we were unable to get pump technicians across borders. So Tunisia is not a big enough oil market to have a full suite of pump technicians in a service base. They either come in from Libya or from Algeria. And given that they had to quarantine for 14 days when they came into the country and then quarantine again when they left the country, clearly none of the big service companies like Schlumberger wanted one of their pump technicians to be quarantining for 18 days to do 3 or 4 days work for us. So we weren't able to get in and really keep the pumps going in the southern Tunisian fields as well as we could. And so we saw a little bit of production declines. Cost control through the year. Our yearly cost of production expense was $9.67 a barrel. So even in April of last year, when crude was selling into the Mediterranean at $20 a barrel, we were generating cash flow. So we look at that cost control, we look at that low cost of production expense as really one of the strengths of this business, that even through a deep commodity trough, we can continue to generate operating cash flow. Normalized EBITDA of $6.6 million in 2020. That is in the face of those commodity price declines. And we managed to increase our 1P reserves by 101% to 5.8 million barrels. Our 2P reserves decreased slightly by 9%, and that's mostly just production decreases. So we've converted probable reserves to proved, and those proved have been produced. COVID risk, aside from the disruptions that we had with pump technicians, things are a little bit slower. Moving trucks around when you have to cross county lines in Romania, things are a little bit slower, but we've had no interruptions in our production, and our timelines we've shifted so that we manage those delays. At the start of 2020, we drilled the Moftino 1004 well. Drilled that on time. It was a couple of days ahead of time, and about 24% under budget. That well tested at 6 million standard cubic feet a day, which is roughly the equivalent of a 1,000 barrel a day well. So very successful well. Very happy with that well. That well continues to produce into our Moftino gas plant. Late in 2020, we managed to begin our workover program. It was, as I say, delayed a little bit by the pandemic, but we're currently showing the results of those workovers now. So production is starting to increase. Now, in Tunisia, when you do a workover, it takes some time to draw down the water to produce the well. So it's not an immediate production effect, but we're starting to see those effects now, and they're coming through quite positively. So in summary, we entered 2021. We've got a good portfolio of organic growth. We now have a balance sheet that we can take that operating cash flow that we're generating, we can apply it to more of the high return projects that we have. And I think after 2020, we've got a team that is really eager to get executing. Some of the stuff we wanted to do in 2020, we now have sitting in front of us in 2021. And so I think everyone's eager to get on with that. I'll turn over to a little bit of the performance outcomes. Production, I think we talked about that. Production's increased significantly in 2020 as we brought 1004 on stream. Health and safety, we had no lost time incidents in 2020. COVID protocols, we put a lot of stern COVID protocols in place. We moved consumables in the field to having a month of consumables. So if we had to shut in the field and seal it from the outside, we could stay sealed for a month. So consumables like lubricants for compressors, food, water, we increased that ability to seal off our facilities. Our ESG, we are a very low carbon producer. So Moftino is a very, very modern plant. We view gas as a transition fuel, and our gas in Romania goes into the generation plants, generates electricity, and it displaces coal. And so if we assume that every unit of gas we produce replaced a unit of coal, then in 2020, our production of gas reduced emissions of carbon by 721,000 tons in 2020. So it is a transition fuel. We're happy to be displacing coal, and we hope to be able to grow that a lot more and displace a whole bunch more coal. Cost control, I think we talked about our $9.67 a barrel, but across the business, we have for 3 or 4 years now shown the cost control that we put in place when I joined as CEO. That is how we remain a robust business, is we can manage our costs. We can't manage the commodity cycle, we can't manage the price of oil, we can't manage the price of gas, but we certainly can make sure that in higher price environments, we take as much as we can in terms of netback, and in low price environments, we're still cash flow positive. Project management, we did a Moftino plant turnaround and maintenance in the middle of a pandemic. We did that on time and on budget. And just recently, we drilled the Moftino 1008 well, again, in a pandemic. I would say that the weather probably affected us more than the pandemic, because we had absolutely horrible weather while we were drilling 1008. And again, that one was on time, and again, a very, very well drilled well under budget. I would encourage everyone to take a look at our results, the full results presentation that we released, especially the environmental and social governance section. which we've really tried to bulk up this year. We have always monitored our emissions. We've always done groundwater testing. We've done this for many, many years. It's becoming more and more important to investors, and I think we're trying to be a leader in the level of disclosure we give. So by all means, please check that out. We're always happy to hear advice as to what else we can include, and we'll continue to enhance that in years coming. Safely drilling the well. This was a big deal. I talked about having to have consumables in the field. I mean, drilling a well when you seal people off and you don't allow anyone but your rig crews onto the site in the middle of winter in northern Romania, that is very much a challenge. So we're very proud of the fact that we managed to do that. You know, we have operations in 2 countries. We have offices in 5 countries. And managing the communications to be able to drill a well and to be able to do our workover program in Tunisia has been challenging, but the staff has really picked up. We always worked remotely just because of our geographic dispersion. So transitioning to remote working has been fairly easy for us, but you know, it's still a strain after we've done it for about a year now, and so it is a challenge. But I think we've managed very well on that. I'm going to hand over to Andrew. He's going to run through the numbers, and so I'll let you hear someone else talk, and we'll go from there.
Jeffrey, thank you. Looking at the numbers, and we'll look at some of the key metrics that we analyze. Starting with production, we can clearly see the 68% increase in production in 2020 against 2019. Production increased to 2,340 barrels per day. And that was as a result of the Moth gas field coming on stream and also restarting at the Schwesh and Eschwesh fields during the year. 76% of our production is gas from Romania. You can also see the natural declines that we experienced in the fields in Romania. And of course, after the year end, in February of this year, we drilled and started to produce the Moth 1008 well, which tested at about 700 barrels a day. In Tunisia, as Jeffrey mentioned already, we saw a little bit of a production decline in the last quarter of the year because of the COVID-related travel disruptions and impact on affecting a workover. Average realized price, really this is the big counter to our production increases. We realized prices of $28 per barrel through the year, compared to $48 per barrel over 2019. Tunisia, you can see the very sort of market decline. As we know, the Brent price significantly reduced at the end of the first quarter and into the second quarter of the year, and we're seeing a steady recovery through the second half of the year, with Brent now over $60 a barrel. And gas is more seasonal, where we saw a sort of a slower decline in the gas price with seasonality as we entered the summer months, and then a recovery which we're now seeing through the winter months. Production and our corresponding netbacks. We have a very strong focus on production costs. Whilst the production expense increased to $8.3 million over the year, that was as a reduction of bringing on additional production. But our focus on OPEX per barrel, we've maintained our levels below $10 and closed the year at $9.67 per barrel. You can see again in Tunisia, there was a slight uptick in the fourth quarter on a per barrel basis as a result of the lower production in that quarter. At our operating netback level, we can see that the impact of pricing outweighed both the increase in production and our reduced costs per barrel. And nevertheless, an outturn of $16.28 per barrel through the year, in a year like we had in 2020, is a pretty robust reflection of the business and the fact that we continue to be positive cash generating throughout the entire year, irrespective of the impact of pricing. At a capital expenditure level, CapEx in 2020 was $5.5 million. Bulk of that was in Romania, reflecting the drilling of 1004 in the year and the pre-drilling activities relating to the 1008 well that we've just drilled earlier this year. Funds from operations was relatively stable at $7.3 million as opposed to $8.1 million the previous year, corresponding to a normalized EBITDA of $6.6 million. So, now that we're a debt-free company, all of our cash flow is available to invest in operations rather than sustaining our financing. Looking at just reflecting revenues and cost of sales, revenue was very stable. Again, same story, increased production offset by lower pricing. Cost of sales increased to $26.7 million, which was mainly as a result of the additional production from Romania and the 2 fields in Tunisia. Within cost of sales, the windfall tax in Romania decreased to $1.5 million, again as a result of lower gas prices. Depletion and depreciation increased by $5 million to $15.3 million as a result of bringing on new production at 3 fields. OPEX, which we've talked about, increased due to that additional production, but again, highlighting our reduced OPEX per barrel. And royalties stayed relatively flat over the year. Net loss, that increased to $9.3 million. I mean, on an operating income and net loss basis, you can see that 2019 benefited from the inclusion of a $7 million recovery of decommissioning provisions, whilst in 2020, our outcome was impacted by the impairment we took at the half year of $10 million, an increase in depletion and depreciation of $5 million, offset by the $1.9 million release of a provision. And the cash flow statement really allows us just to highlight that loss for the provision, as we just mentioned. This also includes at the loss level an offset by the gain on the extinguishment of debt, which is the differential between the face value of the debt and what we paid for it through the year. We reiterate our funds from operations at $7.3 million. But having repaid our long-term debt, cash at the end of the year was $6 million. So again, as Jeffrey highlighted at the beginning, we're debt-free with a strong cash-generating business. And with that, I'll hand back to Jeffrey.
Good. Like I said earlier, we are very much focused on the environmental and the safety, and I would encourage everyone to pick up the full results presentations where we go through this. But some of the highlights, I talked about having no lost time incidents. We have not had a lost time incident in Tunisia for 1,853 days, and we haven't had a lost time incident in Romania for 705 days. Now, that's a much smaller number than the Tunisian number, but everyone needs to remember the entire time that we've been building that gas plant, the entire time that we've been producing, we've never had a lost time incident. The gas plant is modern and efficient. It really does minimize emissions. We have the first enclosed flare in the state of Romania, and our electricity consumption, we're currently running electricity from the plant off of the medium voltage line, but we are installing solar panels so that we'll no longer take electricity off of the national grid, but we will produce all of our own electricity. And that will also help us with our operating costs there, so lower the operating costs even lower. Environmental monitoring, we have the EBRD as our bank. They have very, very strict environmental standards. We complied with those environmental standards for many, many years. Long before those level of standards were required in many companies, and we intend to continue with those standards and hopefully enhance upon them. And we do have annual environmental inspections by the local regulators, and those have always been very productive, and we've never had a major incident. Everyone wants to know what we're doing next. We talk about how big the Satu Mare concession in Romania is. It is very large. It's 3,000 square kilometers. On good roads, driving from the north of the block to the south of the block would take you over an hour, and east-west easily an hour. So it's a big, big block. There's lots for us to do there, and we think there's a lot more Moftino fields adjacent to Moftino, and a lot more gas fields that are scattered around. In Tunisia, we have a very large oil field. We've just posted our reserve reports. We do reserves every year, so we don't do a CPR just when we're doing a transaction. We do an annual reserve audit. Gaffney Klein and Associates did the reserve report for us this year, and the Sabria field in Tunisia, in that reserve report, has oil originally in place of 445 million barrels. So it's a very, very big field that has a very, very low recovery factor, under 1%. And so we think that we can enhance production in that field simply by working that field better. So in Romania, we're looking to drill the Sancrai 1 well, middle of the year. We intend to start that well. That's about 7.4 kilometers southwest of the Moftino gas field. So that's the first chance we get to step out from Moftino and show that there are other gas fields adjacent to our field. We also are looking to install compression in the Moftino gas field in the middle of this year. That will extend and keep the production up. Further opportunities for shallow gas. Once we have that Sancrai well drilled, we'll learn a lot more about what's in the immediate vicinity. And the next area we're looking at is to the southeast, about 10 kilometers to the southeast of Moftino, and we call that the Matarash area. So we'll move on to that. Towards the end of this year, we'll start looking technically at that and moving forward. In Tunisia, talked about how big this field is. It's never had a pump on it. So it's one of these fields that you sort of stumble upon in your career and you go, why isn't there a pump on this field? It's simply because no one has ever sat down and designed a pump program, because this field just keeps pumping away. And we think we can keep it pumping away at a higher rate by putting pumps in. We'll continue to do work on the Shwesh and the Esh-Shwesh fields in the south of Tunisia. These are workover wells and putting pumps in again that can increase the production there. These are legacy fields, so putting in pumps, I think drilling wells into the oil portion of this field is probably unlikely in the near term. But beneath these fields are gas opportunities. And given that they're adjacent to the big OMV pipeline that comes out of the south of Tunisia, the company will now start to transition to look at those assets, at those gas assets that lie beneath our oil assets in Shwesh Asada and Esh-Shwesh. So I think that's a pretty busy 2021 for us. We came out of 2020. Some of these things are rolled over when we just couldn't do them. Some of these things are brand new. So in 2020, we had originally planned to do a 3D seismic program in Romania, but we can't do that because the seismic crew is about 100 people, and during the pandemic, we just couldn't get 100 people. Large gatherings were banned. So the government there allowed us to change that seismic program into drilling a well. And that seismic program had been a legacy commitment that went way, way back. We actually would rather drill wells and get production. So we managed to negotiate that. So it was a tough 2020, but I think being debt-free, all these opportunities in the organic portfolio, 2021 is the year when we're really going to get to work on the organic portfolio. So I think that's the presentation. That goes through the numbers, gives you a little sense of how our year was last year, and hopefully a little view on what we can do in 2021. And I guess I'll hand it back to you, Mark, and we can take some questions.
Fantastic. Thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of the screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you will be redirected for the opportunity to give feedback so the company can understand your views and expectations. Jeffrey, we had a number of pre-submitted questions from investors, and perhaps I could start the Q&A session off with these if possible. The first one reads as follows: what plans are there to utilize the cash flow going forward? Further production increases, share buybacks over time, dividends potentially?
Good question. Firstly, over time, in the long term, philosophically, we believe in returning value to shareholders. So we'll do that in any number of ways. In the near term, returning value to shareholders is through capital growth. Quite simply, we're going to take the cash flow in the near term and apply it to our assets to grow them. To give you an example, the Moth 1008 well, which we drilled at the start of this year, has an IRR above 100%. So these are fantastic places to invest for return. That's in the near term. In the longer term, and the longer term will be determined by the portfolio of assets and the capital allocation decisions we have. But in the longer term, we don't rule out share buybacks or distributions. But in the short term, every shareholder should be screaming for us to go after 100% IRR projects. And that's the kind of things we have on the table right now. So we'll pursue the best returns for our shareholders. And those returns may be share buybacks. But for right now, the portfolio gives us lots of opportunities for capital return in the assets.
Fantastic. Thank you very much. The next question here, what is your estimated price level for oil and gas for the upcoming year?
Calvin, you want to take that one?
Sure, I'll take that. As you know, 2020 was a very disruptive year in both oil and gas prices in the world and for our company, given the pandemic and the reduction in demand that the pandemic caused. It's really rebounded in late 2020 and early 2021 so far. As Andrew mentioned, Brent price is above $60 a barrel. The gas price in Romania, if you go onto their gas market website, is $6, and sometimes the day ahead prices shot up over $8. So it's returned very strong, and we see this going forward through 2021 and onwards.
So yeah, look, a very positive view of commodity prices. However, I would say these aren't the prices that we budget the business at. So when we build our budgets to run the business and to meet our return thresholds, they're much lower than $60 and $6 that Calvin was talking about. The reality today is commodity prices have rebounded higher than I think, much higher than what we're budgeting the business at. And so that's just excess return for us.
Fantastic, thank you. Next one we've got here is, should Sankrai in Tunisia be successful, what will you do with the extra revenue?
Well, I think the last, the first question I answered is the allocation of capital. We're not in the business of just spending money. We're in the business of generating return. So if both of those are successful, they lead on to other capital allocation decisions. For example, Sankrai being successful, you have a spread of decisions that are laid out before you. Is it big enough to build another gas plant? Do you run it up through Moth? What do you do with that if it's very big? So it spreads out a sort of a scheme of capital allocation decisions, which include the Matarash fields, which we think are due east of where the Sankrai would be. And that's the same in Tunisia. But as we hope and as we think we'll get more and more successful, then at some point you start to have to question: are you allocating capital properly, or should you return it to shareholders? So that's why I commented that philosophically we're not opposed to returning capital to shareholders. We just want to make sure that we're getting the best return, whether that's through an allocation to shareholders or an allocation to an asset.
Thank you. And a direct one, I guess, for you, Jeffrey. You came out of retirement to run SERINUS. Do you plan to stay for the long term?
Yeah, I wasn't very good at being retired, to be honest. Yeah, look, I can't. Yes, I was retired. No, my wife wasn't happy with me being retired, and I'm probably better when I'm working on something. The reality is, I took this role because I looked at these assets and I thought, abnormally for a company of this size, the assets are disproportionately good. So there's lots of running room. I'm not done with this. So no, I have no intentions of going anywhere. I have an intentions of finishing the job. If you look at, I think I've done this for 4 years, so I've shown that I'm not just quickly in, quickly out. But there's lots of challenges that we've achieved, but I also think there's lots to go. There's lots of things we can achieve with this business, and I kind of like a fight. So yeah, we're here for a bit of we're here for the future fight.
That's great to hear. What would you consider the current investment risks at SENX?
Well, I think I hope there's no more global pandemic risk. Look, we have standard industry risks, and then we have specific SERINUS risks. On the standard industry risks, resource companies are always taxed. I mean, resource companies, whether they're mining, whether they're gold miners, diamond miners, oil companies, they're easy for governments to tax. I think that budgets have been stretched with the pandemic, and I think that globally, not just in our jurisdictions, but globally, taxation will become a risk for resource businesses. And so I think we have to keep an eye on that. There's always commodity risk. Hopefully that is stabilized, but that's always out there. And then risks that are specific to our business. We intend to grow quickly. So that means human capital risk is out there. We need to find the right people for the right jobs. And that's not always that easy. When we had a lot of debt, it was hard to get people to take a look at this business to come and join us. We've been very, very successful building the team so far. I'm really proud of the team we have. But I think the human capital risk as we grow is out there. There's always subsurface risk. Sankrai is an exploration well. I don't want anyone to think that it's another Moftino development well. It is an exploration well. And as smart as we think we can be, and as much as we can study, it remains an exploration well. And it's a kilometer down through solid rock. We think we know what's there, but you're never certain. So those are all real risks that people who invest in oil and gas companies need to be aware of. And so we're not shy when people say, what are the risks? Well, there's getting people, there's getting taxed, and there's getting the technical stuff right. I think those sort of sum up the big risks.
That's great. Last few questions before we move on to some of the live ones. Would you consider the current valuation of the company fair, and what could you see one of SENX's peers judged at given the current stage of development?
I don't think that any CEO of any company ever has said they thought their valuation was fair. We sit inside the business. We get to see all the assets. We know what those values of those assets are. We do our best to communicate the value to our shareholders and to the world. But no, I don't think it's fair. I think our share price, particularly now, is deeply undervalued. And I can say that with a couple of benchmarks to look at. Firstly, like I said, we have our reserves independently audited every year. And if you look at Gaffney Klein's MPVs, we find that those MPVs, simply the reserves, this isn't the resource, this isn't what we have in the future, simply the discovered reserves that we can produce and make money off of should be valuing us above 5p. And we're below 3p. That is particularly offensive to me. There is growth in this business beyond the reserves. And there's certainly value in this business beyond the reserves. So yeah, I see that, and I look at that, and I think that that's just not right. And then, that's how you value the reserves and the assets independently through a reserve engineer. But then you also have to look, we generate cash flow. We generated cash flow through one of the worst commodity disruptions I've lived through, and I'm old. That cash flow has a value, and if you look at normal metrics for valuing cash flow, we trade at very, very low multiples of cash flow, and people can argue that small companies shouldn't trade at multiples of cash flow, but the reality is that's what companies. I mean, we're here to make cash, and so we should be valued. Every company should be valued at cash. And if you look at those numbers, then I think we're deeply undervalued as well.
Thank you. Next one we've got here. Are there any plans to continue expansion at Moth?
I guess that Moth means at Moftino. I think Moftino, we drilled the 1008 well. We've got a gas plant there. We've got 4 producing wells. There's another location that we've identified, but it looks like the knowledge of our reservoir is such that we might not need that location to produce the field. So I think the work at Moftino goes through, making sure that the compression goes in properly and at the right time, and sensibly managing the field to get the most out of it in the quickest amount of time. So no, I think if there's more big development work, it will be elsewhere. I think Moftino, the development will be compression, and that's about it.
And we also have some other sands behind pipe that we'll look at developing once the current sands have declined.
Yeah, that's a very good point, Cal. Thanks.
Yeah.
One we've got here in Tunisia, could the pumps be installed sooner? It was previously stated this was a simple process. What steps need to be taken before installation?
Well, putting the pumps in is a simple process. Ordering the pumps and the processes in Tunisia are largely getting approvals. So getting approval from our partner in Sabria, I think that's the one thing we don't control. And it's no secret that politically Tunisia is a nascent democracy, and it takes time to get approvals. I think I can sum this up by saying I've been with SERINUS for 4 years, and I think I'm on my 8th or my 9th energy minister in Tunisia right now. So the speed in Tunisia has very little to do with our ability to execute the ordering or the design or the installation of the pumps. It's more making sure that everything is proceeding properly. And I say that because previously this company had gone ahead and did things without proper approvals, and our partner turned around and said, well, you didn't get that approved properly, so we're not paying. So it's something you have to do or you'll be destroying value. So I think it's very, very important that we don't try to rush this. Be assured we'll do it as quickly as we possibly can. It's value to us as well. But there are limitations that we don't control.
That's great. Just coming on to the penultimate one we've got here. Is there any scope to bring the list of works detailed in the presentation forward, given the recent increase in commodity prices?
Yeah, again, a lot of this hasn't. At the end of the year we had $6 million in cash, so it's not simply that we have to accrue operating cash flow to do this. That was the history of the company with the debt. You had to accrue enough operating cash flow to meet your debt payment, and what was left over you had to accrue for your plans. We have now got operating cash flow and a plan and capital plans that are scaled towards that. So what you're left with is, even if commodity prices jumped way up, there's only so fast you can move in build. For Sandcrack, on Thursday, when we were having our board meeting to approve the results, I was able to show the board a picture of a guy standing out in the middle of a field with a satellite surveying rod, getting ready to start building a road for Sandcrack. It's only so fast you can build a 3-kilometer road through Romanian cornfields. So it's only so fast we can get permits to build those roads. And so there are practical things that just make it impossible for us to speed things up any faster than we already are. Again, we are a company that's in a hurry. We want to get these things done because we want to move on to the next. But we're not so much in a hurry we're going to slip on permitting, or that we're going to rush construction so that we don't have properly built foundations for drilling pads and these sort of things. And those sort of things take some time. So yes, we'll accelerate as best we can, but there is a practical, real life constraint on that.
That's great. And the last one here we've got of the pre-submitted question: is there any update on the arbitration request?
Yeah, I mean, it's a slow process, especially when you have a former partner who does everything they can to drag their feet and obstruct. And so the latest update on the arbitration is the tribunal is being pulled together. And of course, our former partner is doing all they can to make that as slow as possible. They won't approve any suggestions that we make. So that gets thrown back to the ICC panel to make the arbitration tribunal. So it's slow, but it is progressing. It is progressing.
That's great. That concludes the pre-submitted questions. As you can see, we've had a number of questions in from investors during the meeting itself, some of which we've touched on already. But could I ask you just to click on that Q&A tab and just read out the question where it's appropriate to do so and give your answer? That'd be fantastic.
Okay. There's a lot here. So where we've talked about some before, I'm going to just skip them. And I hope people who have submitted them understand I'm not ignoring them. I think we might have already answered it. Very quickly, when is the work on the pumps in Tunisia planned to start? We're working on them right now. Again, the issue is not working on designing the pumps or actually ordering the pumps. The work is getting in position that you've got authorization properly authorized from your partner to do that. So that is progressing, and our partner has approved the capital plans, but it does take time to get signatures on paper from them. So as fast as we can, but we're working on those pumps now, and our schedule hasn't dramatically shifted from any schedule we've presented in the past. Andrew, do you want to answer how is normalized EBITDA calculated?
Sure. Well, I'll start with earnings before interest, tax, and depreciation. So you add those back to the earnings level, and then you adjust it for non-recurring, irregular or one-off items. So, for instance, the impairment expense, share-based payments, the release of provision, and this year the gain on extinguishment of debt, and that will get you a normalized EBITDA.
There you go, corporate finance. So I've got a question here. There's a question here about our forecasts for cash, and I think this is a good opportunity to say that SERINUS does not give financial guidance, so we don't give projections on net cash generation. We give an idea of the projects we're going to do. From that, you can build a production profile. We're fairly transparent with the revenue we generate. So, we say frequently we sell our crude in Tunisia to Shell. That sells at a premium to Brent because we sell it at the Saharan differential. But we have a lifting cost of $1.30. So effectively, the premium and the lifting costs offset each other. So effectively, we sell our crude in Tunisia at Brent. And as Calvin said, the day-ahead market in Tunisia or in Romania for gas can be found on what's called the BRM, the Bucharest Commodities Exchange website. We have a formula that calculates our price from that. So we won't be far off of that. So if you have our production, you have our revenue. In every presentation we have, in every corporate presentation, you'll find our calculations of after-tax netback. So that will give you an idea of what those barrels are earning us after tax. And there you go. You can pretty much make a good back of the envelope guess, and that's not too far off. But we do not give financial guidance. We follow ISS's position that financial guidance is detrimental to both shareholders and businesses. And so we try to hit the highest threshold of governance, and that means that we don't give financial guidance. Simon, great presentation. Well, thank you, Simon. Why do you think the share price doesn't reflect the clear progress management is making, and the market cap doesn't compare with the others in the sector? I was in the capital markets for a long time, and I don't think I've really seen a share price that is so frustrating. The answer is I don't know. We try to communicate very, very clearly. We try to do our projects very, very efficiently. We try to beat the time schedule, and we try to beat our capital schedule. And for the last 4 years, every single project we've done, we've managed to do that. I think, unfortunately, over time, we will win this one. But right now, it's pretty frustrating because I think we're very, very undervalued. And every opportunity that Mrs. Auld gives me to spend more money, I try to buy more shares. And look, I just think there's lots of value, and it's very transparent value. I also think right now we're in a dynamic market where people are moving around money very, very quickly, trying to hit opportunities, and it's more a trading market than an investing market. And I think long-term cash flow generating businesses are investing markets. We're not a trading business. We're not one where we're going to announce that we're drilling a well and we're at 800 meters. Now we're at 900 meters. We're an investment. We're not a trading opportunity. And I think a little bit of the environment right now is more a trading environment than an investing environment. Calvin, we got a question here. How does the Romanian windfall tax affect viability, attractiveness of further efforts at Romanian exploration and production? I'm going to let Calvin answer this one because Calvin's in the face of the Romanian authorities all the time on the windfall tax, and he has some particularly valuable insights into this. Cal?
Yeah, thanks, Jeff. Yeah, we've been engaged with the Romanian government on this tax for quite a while, and it's a very poorly constructed tax, just on how it doesn't really take into account the full investment that the companies make when they calculate what you pay. And we think that this tax is actually a detriment to Romania itself and not in its interest. We've had meetings with the European Union Energy Directorate, and they very much are encouraging Romania to increase its gas production, both from an energy security standpoint and also from an environmental standpoint to start replacing coal in Europe. And this tax has really created a stagnant production growth in the whole country for natural gas in Romania. And at the same time, the demand for gas in Romania has increased. That's made Romania a net importer of gas, which, given its gas resources and even the potential to grow, really doesn't make much sense for the second largest gas producer in Europe as a country. And so we think the windfall tax does impede investments, more the deeper targets in the country, the more expensive wells, and it is having that impact. And we think that given the Romanian government's interest in joining the euro in the future, and natural gas is their competitive advantage for them, and they can if they encourage the onshore growth and start exporting gas, it could be a tremendous driver for the Romanian economy going forward. So we've been trying to get that message across for them, that this tax is an impediment to growth in natural gas in the country, and we think it should, for starters, not apply to new projects. A lot of this, it was applied to legacy projects like OMV, that they bought the fields 20 years ago when they're in later life, and Romgas and OMV produced 95% of the gas in Romania, so they're really targeting these legacy. But we feel that we can get through our engagement with Romania, we'll hopefully move forward on this windfall tax and get something better in place.
Thanks, Cal. Okay, next question. Yes, Steve has asked why David resigned, and I think we should talk about our board. On Monday, we were lucky enough to appoint 2 new directors, a gentleman named John Kempster, who is a very, very experienced director. He's been on the board of Sports Direct, Ted Baker, so really has great non-executive director experience, and we're really lucky to have him. And we've also appointed a young lady named Natalie Fortescue. Natalie has city experience. She was an oil and gas research analyst. But more recently, she worked for Ganel, but more recently she's been working with Premier on their Premier Chrysler merger. So she's having a particularly busy week this week, but after that, again, we're very lucky to have her. Now, those two directors are replacing two other directors. In the first instance, when the Kolchak Investments used to own a considerable portion of us. Since I've joined, they've gone from just over 50% down to about 8%. Now, when we moved the company to AIM, we put a relationship agreement in place that at certain thresholds of equity ownership, the Kolchak Investments had the ability to appoint directors. Now, when we did our recapitalization equity raise, the Kolchaks chose not to partake, simply because Kolchak Investments no longer invests in natural resources. And so they were naturally diluted down, which meant that the relationship agreement fell away. So there is no longer a relationship agreement because Kolchak Investments is down below, well, they're at 8%. And so that meant that we had two Kolchak investors and two Kolchak directors. And so David very graciously resigned. He was a great director for us, very, very smart man, and was personally for me a good shoulder to reflect with. Equally, Eleanor Barker has decided not to be reelected at our May board meeting, our May AGM. And that's simply because we were looking for an accountant that could chair our audit committee. And as well, Eleanor was one of our legacy Canadian directors, and we wanted to have more British board experience on the board. So both of those directors were great directors for us. There is nothing untoward about why they left. They didn't leave because of a fight we had or anything like that. They left because for the betterment of the board, this company is growing and changing, and they recognize that. There's a question here from Nathan. Can we clear up the situation with the Warsaw Stock Exchange? No, I can't. Never seen anything like it. We have one share. It has the same ISIN. So if you trade a share in Warsaw, it's got the same ISIN as if you trade a share in AIM. The only difference is that Warsaw is a regulated EU exchange, and AIM is not. AIM is a sub-exchange of the London Stock Exchange. So we can issue shares on AIM without filing an EU prospectus. And we do that. And when we issue shares, we don't file a full EU prospectus, which means the shares are not qualified to enter the Polish depository. Same shares, but not qualified with a prospectus. There's a good reason for this, for us. A prospectus, the last time we did it, the prospectus, the 2014 prospectus is on our website. It's an 800-page document. I think it's on page 700 and whatever, where it says that it cost us about $1 million to produce that document. And I hope that everyone thinks that there's a better use for $1 million than qualifying shares on a stock exchange, wherever that stock exchange is. So we have a very weird situation where there are 78 million shares eligible to be held in the depository in Warsaw, and the rest, and 100% of the shares are eligible to be traded in London. That does not explain why at times the company's market cap as valued on Warsaw has exceeded that of Tullows. It is something I don't understand. I don't want anyone to get hurt trading shares when they don't have to, but to buy a share at 8, 9, 10 times the price of the same share that you can buy in London where it's more liquid doesn't seem to make very much sense to me. So can I clear up the situation? I hope I've given you an understanding of what the situation is, but I have no idea why someone would buy the same share for 10 times the price. Investors are worried about the latest board changes. I think I've given the reason for the board changes. I hope investors aren't worried, because I think that that David and Eleanor were great directors. I'm sad to see them go, but we're not going to be a board of 10 people just simply for cost, and that the directors that have stepped up have a relevant experience for what the company intends to be. When will we give a Q1 update? Do you have the schedule?
Give me 2 minutes.
We publicize the schedules for all of our updates at the start of every year. So we'll give you, Andrew's just run to find out what the exact date is for the Q1 update. So I'm going to move on, and he's going to bark out when our first quarter update will be. And that, I think, is all the questions that we have. Sorry, Gareth, can I talk about the Moth compression to stabilize production? Absolutely. Moth is a shallow gas field. So as we produce certain zones, those zones deplete. We put in production on the surface to help suck out more gas and to keep the compression into the gas plant high enough that we can keep pulling gas out of the field. As Calvin said, there are zones that we have not completed. So gas zones that we discovered as we were drilling wells that aren't completed. So we'll be able to put those zones on. Now, as those zones are sometimes higher up, they don't have as much rock sitting on them, so they're not as pressurized. And so compression helps us produce that incremental volume as well. It's not, as your question says, to stabilize production, it's to extend production. So the production is very, very stable. We have a pretty predictable decline rate. Our reservoir engineering models predict that very, very well. The production is very stable, but it does decline. And so to make sure that we extend the life of the field as long as we can, and this is normal in a shallow gas field, you put production compression on the surface.
I think, Jeffrey, you and the team have pretty much covered every single question off. So
Yeah.
Thank you very much indeed. And of course, the company can review any further questions that are submitted. Jeffrey, may I ask you just for a couple of final words? We're just coming up to the hour, and you've been extremely generous with your time in the Q&A session. Just for a few final words for investors.
I'll answer the last question on the date of the quarterlies. We'll announce those at the same time we have our AGM. So you'll have quarterly results out of 13th of March. 13th of May. 13th of May. I should add that we do not routinely schedule operational updates, but if there's things that happen operationally that we think are meaningful and valuable to shareholders to know, we've never been shy about putting out operational updates, but we don't schedule them, and we don't. They're not that predictable. So I think, as you said, Mark, that's all the questions. Look, I would first like to thank everyone for providing the questions. It's much better to answer direct questions than to just run through a presentation. So thanks everyone for providing the questions, and hopefully we've clarified some of the things that might have been niggling with people.
That's fantastic. Jeffrey, Andrew, Calvin, thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback. If you've accessed this meeting from our website, the feedback page will appear in front of you. If you've accessed it via the link in the email we'll send you, simply log back in and submit your feedback. Take just a few moments and be greatly appreciated by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you very much for attending today's presentation. That now concludes today's session. Thank you and good afternoon.